All right, Bulls and Bears, back with another dose of economic reality. We've got a lot of financial/economic news to get caught up on today. The economy continues to go deeper and deeper into the point of no return, into lands never traveled or places never seen before by the human eye. Let's go ahead and get right into it. Please make sure you are subscribed. This is just a one-man show. It's just me. I don't have any editors, no producers, no content curators, any of that. Everything is just myself. So appreciate your support by at least subscribing. Thank you very much. Let's go ahead and get right into it. The economy continues to chug along with the assistance of a lot of money creation, a lot of support. The politicians, the bankers, they're doing their very best to convince people that the economy is good, that it's strong, that the consumer is good and strong. In the meantime, you've got the consumer on average buried under the most debt we've ever seen. Now, one of the big areas that we look at, one of the most important areas that we look at here on this channel is the housing market. We look at home prices. We look at all the data, what's happening with homes, the types of loans being given out. We know that the government is now buying most mortgages that are given out. That's unprecedented. That's even worse than 2008. We've got 0% down payment mortgages back. We've got down payment assistance programs also backed by the government in every state, right? So this is bubble inflation 101, what we're seeing today, folks. And why is it so important to keep this housing bubble propped up? Well, take a look at this. U.S., the world's largest real estate, the world's largest asset class is the U.S. here. Take a look at this. And Investopedia put this out. $47.5 trillion. U.S. homes are worth more, and this was as of 2023. It got even worse since then. With values rising another 5.3% over the previous year. That's $2 trillion, bringing the total up to $47.5 trillion, right? To put that into context, that value is more than the ever-growing national debt. Now, it gets crazier because think about China with a population about 4 times what it is here in the U.S. Even China is only $42.7 trillion, right? And we are $47.5 trillion. So that's why it's so important for the powers that be, for the bankers to keep this economy propped up, especially with the housing market, keep the housing bubble inflated. And that's a big part of the game right there. So, of course, we just mentioned a few different ways that they're keeping this housing bubble inflated. Another part of it is rising rents. When homeowners don't have a cheaper place to go to, for example, if you could sell your home, it's usually a reward. You could sell your home, hopefully take some money out of it, get the equity, and go rent somewhere while home prices maybe cool off or come back down. Now, even renting today is what owning a home was just 6 or 7 years ago. You're paying rent that's the equivalent to what mortgages were just a few years ago. And in some places, it's just as bad as having a mortgage, right? It's very difficult now to find a rent that's much cheaper than mortgage, right? In some areas there is, but get the point. It's getting very difficult to find affordable living, whether you're renting, whether you own. And that's why we have so many people priced out of the housing market, and they can't even afford rent on their own. We've got record numbers of people working multiple jobs. And some people say, well, it's just the gig economy. Everybody's doing a side hustle. People are doing YouTube channels. YouTube channel, who would do that? Well, let me show you let me bring up a chart here, because this is the number of people working not just a side hustle or part-time, full-time jobs here. Let's take a look at this. First of all, take a look at this chart, and we see multiple job holders here. And this was put out by Macro Alchemist. Multiple job holders, way above where we were going into 2020. Remember when we saw this in 2019, I warned something big may happen in 2020. Of course, it did. We all know what happened. Now it's even worse. And this is one of the reasons why I'm predicting something big to happen very, very soon. If you've been watching my videos over the past few weeks, you know that I've been calling for something huge to happen this year within the next few months. Because if you go back, even the financial crisis wasn't this bad. Unaffordability is worse now than what it was during the financial crisis. right? So multiple job holders, but let me give you some more evidence on this. It's not just multiple job holders working part-time jobs or gig economy jobs, multiple full-time jobs. Look, again, way worse than the 2007, 2008 financial crisis. Why is that? Because unaffordability is worse now than what it was back then. So then you may ask the question, well, if unaffordability is so bad, why aren't prices coming down? Why aren't prices coming down to where people can afford, right? You should see a price crash. You should see cost levels come down. The cost of living should come down. Well, that's because a lot of the programs out right now to keep the bubble inflated, just like we talked about at the beginning of the video. The housing bubble is just one of many examples of what they're doing to keep the bubble inflated. All right. We also have a lot of the jobs added are government jobs. The government jobs. Take a look at this chart right here, and let's talk about the jobs numbers that just came out here. Well, actually, not a chart, but a headline. 1/3 of the 206,000 jobs added in June were government jobs. Folks, they can create as many government jobs as they want to. All they have to do is borrow more money and create a new agency, expand the agencies, and do whatever it takes to pad the jobs numbers. Now, when you look at the unemployment filings, it's over 200,000 a week. We're already losing 4 times as many jobs that we're adding, but it's even worse when you look at the jobs added. 1/3 of them are government jobs, right? And a lot of these jobs are jobs reemerging that were gone with the health crisis back in 2020. Jobs gains that we're seeing, a lot of them are just those jobs being re-added and government jobs. That's how crazy it's gotten. And also the quality of the jobs is declining. The quality of the jobs is declining. And look at a lot of the jobs that are just gone and are being shipped to different countries. We have John Deere outsourcing now or laying off in the United States and sending jobs to Mexico where the labor is cheaper. And that's another danger of a high cost of living is the high cost of living demands higher labor costs. Why you see so many people striking and demanding higher wages because they can't keep up with the cost of living with their current wages. So you see strikes, hundreds of different strikes happening just this year in 2024 because people cannot keep up with the cost of living. They need higher wages. And what are companies going to do? Are they going to just give people unlimited raises? No, they're going to send jobs overseas where the labor is cheaper. They've been doing that for decades, but it's even worse now with the high cost of living. Next, let's talk about what's being warned or what's being warned about by Citigroup. The central bank could slash rates by 200 points over 8 straight meetings as the economy heads to sharper downturn. That's what Citigroup had to say. That's an analyst over at Citigroup, folks. A 200 basis point rate cut total and 8 straight rate cuts. So what did they see? What does Citi see on the horizon that we're not being told about in the media? Get ready for a bonanza of rate cuts from the Fed. It's going to start in a few months. What's going to trigger that? Extends all the way into the summer of 2025. In a note on Friday, the bank, Citibank, cited fresh signs of a slowing economy for its view that the Fed will trim rates by 25 points 8 times starting in September. I predicted something bad happening by the end of October. These people, a lot of analysts are predicting something bad is going to go down in September that's going to justify these rate cuts. They say the benchmark could be lowered down to the 3.25 to 3.5% range and remain there until 2025, right? So all these programs that are being paused right now, we have student loans no longer being paid back. First, they paused them in 2020. They tried to restart it back in October. That lasted up until just recently. They had to pause millions of student loan payments once again because people are not able to keep up with these prices. We have many different rescue programs across many different economic sectors here. But back to what Citi's saying, they said, quote, the economy has cooled off from its heady pace in 2023 with inflation resuming its slowdown after some unexpected stickiness. Folks, it wasn't unexpected if you've been on this channel. The Citi analysis led by Chief U.S. economist Andrew Hollenhorst. Unemployment also ticked up through 4.1%. We talked about that here just in our last report. And it was as low as 3.4, I believe, at one point. So we're almost up a full percentage point. And in the past, before recessions, we've always seen the unemployment rate start to tick up. Right? It's rare that it starts to tick up and then just starts going back down again. Right? So we're headed into something big, something massive. Will it be just a continual decline, or will something massive break? Right? We talked here many times about all the different possibilities, all the things that could bring this economy down very quickly, or it could be a continued unwind that would accelerate faster and faster as it begins to get more and more difficult for the average person just to get by financially. Now, while still on the topic of inflation, the cost of living, price levels, we know that there's a lot behind it, but one of the things that's been put out there is corporate greed. How much of this is corporate greed? Well, it's definitely a part of it. And let's see some examples here, some information that actually underpins that corporate greed is real, right? So on one hand, you would think with everything being so expensive that maybe the CEOs would take bigger pay cuts or take lower pay in order to try to maybe charge less for their services or products to help the consumer, right? To help people. Of course, they don't want to do that, but they want to help themselves. Take a look at this. CEO pay jumped to a record $23.7 million. And that's up 11.4%. And we see that now stock buybacks are jumping up again. CEO pays increasing again. So we know that a lot of this is greed. The CEOs can get by on a couple $1,000,000 a year. The CEOs do not need that. Are they going to take it? Of course. It just goes to show you that no one's going to look out for you. No one's going to try to help you. The politicians, the bankers, the CEOs, they're looking out for themselves. That's why you have to look around, realize what's going on, understand this so you can prepare what we're headed into. And I think a lot of us here on this channel are going to be prepared just fine, but it's scary when you look out there at what most people are thinking about and looking at. They're not even thinking about this stuff. They're not even concerned at the least. Now, still on the topic of consumers struggling to get by, we know that one area that is an example of when people start running out of money, when their credit cards start getting maxed out, when the debt levels become unsustainable, is people can no longer afford rent. So what happens? Well, we see rents drop. Take a look at this report right here, and let's see what's going on with rents. Rents drop now for 10 months. 10 months in a row, rents have dropped. And folks, that's a sign that there's really weakness amongst the consumer. Home prices, that doesn't tell you really what's happening with the consumer. It tells you that a lot of people are getting loans, and even though volume's at all-time lows, a lot of the homes that are sold are on borrowed money. But rents, not too many people borrowing money to pay the rent. So, of course, now as people get tapped out, as they get maxed out, rents are dropping. The median asking price for rent for 1 to 2 bedrooms, includes studios as well, dropped by 0.7% from a year prior. Now, that's a tiny drop, but with everything else going up and home prices going up even year over year, that is a sign that something is happening amongst the consumers, and consumers are having a very, very hard time. Oh, and another piece of news that I wanted to fit in here. I just got this right before I hit record on this video. Somebody sent this over to me. And this is back to what we talked about, corporate greed, right? So banks are doing very good. They just passed the stress tests. Of course, the stress tests are basically phony because we know the big losses that banks have on the books. They're not actually counting the unrealized losses. It's just considered an underwater asset. But if you look at the big picture, banks are in worse shape now than they were before the financial crisis in 2008. So you would think that if banks are really doing good and everything was fine, they would be offering a lot of free products, like free checking accounts. Look what's being reported out of Benzinga. Benzinga, let me pronounce that right, Benzinga. Largest consumer bank, Chase, hints increased costs for consumers' everyday banking services. So they're phasing out, or likely to be phasing out, free checking accounts. JP Morgan Chase issued its warning to its 86 million customers: prepare for new charges on their bank accounts. The largest consumer bank, one of the top credit card issuers in the country, plans to pass on the costs of higher regulations to its consumers. First of all, what higher regulations, right? Pretty much everything they want, they get. Anything the banks want, they get. Look at the zero reserve requirement that was brought out in 2020. That's still in place right now, even though the emergency is long over with. The 2020 emergency that some people called an emergency, other people didn't. But a lot of governments say they called it an emergency. They shut things down. That is still in place. The zero reserve requirement is still in place. In fact, banks recently celebrated because it was talked about, or it was discussed, that there was going to be a change in the reserve requirement here. And let me just find this article for you here. Take a look at this. As reported out of MarketWatch, bank stocks gain after report about lighter capital requirements. It was discussed that there was a possibility of banks having to hold, I believe it was 5 or 6% of reserves on the books, meaning for every $6 million they had in deposits, they can loan out $100 million. Right? They were just the talk was to require about 6%. Right now, it's still zero. Right? So what happened? Of course, bank stocks gained on that because the more money they can loan out without actually having to have it, then they make more money, of course. So investors like this. Bank stocks actually gained from this, right? So folks, this whole thing is being propped up with all these shenanigans and different ways that they're keeping the economy looking like it's growing. And the biggest way is for people to borrow money and spend borrowed money. It makes the economy look like it's growing, and it makes the consumer look like they're strong, when really it's borrowed money that's being spent. It's mostly borrowed money being spent. The savings rate has plunged. We're close to a 40-year low. It's kind of bouncing along near the 40-year low right now if you look at the chart. And it's likely just to continue to get worse because everything that caused the inflation and caused the price levels to be where they're at and the high cost of living, everything that was done to get us to these levels is still being done. And on top of it, they're looking for new ways to keep bubbles inflated, to keep prices elevated. They don't want deflation. Again, imagine deflation in the housing market with a 40-something trillion dollar value of U.S. real estate. Imagine if that got cut in half. You're talking about $20 trillion haircut. Folks, the economy would never recover from something like that, right? So if we do start to see a downturn in the economy, it's likely to see, you're going to see rate cuts. And we've got Citigroup out there warning now of rate cuts this fall. We've got other people out there, other economists, saying rate cuts are just a few months away because the jig is almost up, and the foolery is almost going to be, it's going to be obvious to everybody pretty soon. Not everybody. There's always going to be some people that are just going to keep their head buried in the sand no matter what. But people are waking up and they're seeing what's going on. They're seeing it not just on reports like this. They're seeing it in their own budgets, in their own pocketbooks, right? Right. That's why we have the biggest wealth transfer right now happening up to the top 10%. And we already know that the top 10% own about 90% of all stocks. Just one example of how the wealth is actually divided in this country. And let's close it out here with another example of what they're doing to try to keep the bubbles inflated. We know that people are getting behind on their credit card payments, just behind in general with the cost of living. So what do they need to do? They need to find ways to forgive debt. We have another 45,000 people in Minnesota are going to be qualifying for student loan forgiveness, or some student loan forgiveness, right? So where does it end? If we give loan forgiveness over here with student loans, why can't we give it over here for medical debt? Why can't we give it over here for real estate debt? Why can't we give it over here for credit cards, right? A lot of people are asking the question, why is it just the students that get the forgiveness? Now, the argument is, well, the students, they had good intentions. They're just trying to get an education, versus someone that went to Las Vegas and gambled and partied and ran up their credit card. They're saying that these people running up their credit cards don't deserve a debt forgiveness, but people trying to get an education, they deserve it, right? What's your thought on that? Who deserves debt forgiveness? Forgive all the debt. Some people are out there saying that. Just get rid of it. Just hit the delete button, just like you would if somebody filed bankruptcy. And people say, well, no, the economy could never put up with that or could never handle that. Folks, if they can print $35 trillion or borrow it into existence, couldn't they just borrow the money that's lost from all the loans being forgiven? And if the banks don't have to have any money in reserves, even if all the loans are forgiven, is that really going to hurt the banks? Not really. It might take away some of the CEO pay, but it's not really going to hurt the banks when you look at what's happening right now with the zero reserve requirement, folks. It's all a big scam, folks. Let me know what you think about all this down below. And please make sure you subscribe. Come back for more news, economic updates. We're going to get through this financial turmoil. We're going to get through this financial storm together. And we're going to come out, I think, very nicely on the other side. Talk to everybody very soon. Keep stacking. Bye for now. Peace.